Coming up, Alberto Gallo of Andromeda Capital Management. Stay with us. This is Bloomberg. Let's get a view then in terms of the politics and the market impact and build in and bring in Alberto Gallo, CIO and co-founder of Andromeda Capital Management. Alberto, thanks for joining us. There was a note out from Morgan Stanley on the politics of France saying buy the dip. There is now an opportunity to add French equities. Would you lean into that? Would you agree with that view?
Happy 4th of July. I mean, generally, the fear that we had in Europe has been overdone. It's been a buy opportunity. The probability of a far-right majority in France is near zero. There's very, very low probability of a far-right majority. So it's going to be a hung parliament, and a hung parliament in France is a fiscal non-event. So we have already seen investors running for cover on their shorts. There was a massive large short in credits. We have not seen the covering on the equity market. So I would say that there is more tactical upside in equities.
That's interesting because you see there's a 0% chance, almost 0% chance of a majority for the national rally of Marine Le Pen post that second round of voting. So you do see tactical opportunities still in the equity markets. That trade hasn't fully closed out. Where does that take you, Alberto?
So in the medium term, what we are seeing in Europe and in other parts of the world is that governments continue to spend. So obviously, government bond spreads have widened, but they're not really what we like right here. Where is government spending going? It's, the real economy, it's going to the private sector, it's going to consumers and subsidies. So the private sector, when you think about credit spreads, the probability of defaults of investment grade or high yield firms, that's not going to increase because governments are spending more. Actually, it's going to go down. So we like credit spreads when there is fear. Part of that rally has happened at the index level, but there's still sectors where spreads are attractive, like banks or the European periphery. The same can be said for European equities, which have been, coming down because of these fears. Medium term, however, the real event is Donald Trump, where we estimated in June an 80% probability of a win. That's based on state national polls, and it's based on the swing states where the Democrats are still weak. So what does that mean? It means more spending, more inflation, higher government bond yields, and stable credit spreads. But it's a short-term risk positive. It clashes with what central bankers are trying to do. The Fed wants to cut rates. We saw Jerome Powell at Sintra the other day. They want to cut rates, but they're having a hard time because they need more evidence on inflation data. So right now we have a bit of weakness. There's a bit of concerns about recession or slowdown in the economy, but we might have, a big spender coming in at the end of the year.
What you're suggesting, Alberto, is that the French politics is really just the intro course, the entree course to the politics of the US. An 80% chance of a Trump victory is your assessment at this stage. So there's that inflation risk, and there's the potential, you suggest, of derailing the Fed's cycle, that cutting cycle that the markets seem to be positioning for a September start to that. Still a debate, of course. How then do you position to that? Are you selling off the long end in terms of treasuries? What are you buying in terms of equities? How are you positioning around a potential Trump presidency?
That's right. Right now, there's a lot of concerns about weakening in the U.S. economy, and we are seeing it. We are seeing it across consumers, across housing, especially the weakest part of the consumer, those that are affected by Fed funds rates above 5%. So it's essentially the households that use credit cards, that use auto loans. However, with some Fed cuts, one or two cuts, right, and then potentially a deficit above 7%, which is what we would see with Trump in 2025, we are actually set up for a reacceleration of the economy, or maybe not, definitely not a deep cutting cycle. The market is not positioned for this. So you're going to see higher treasury yields, you're going to see higher inflation, and also real assets going up, whether it's gold or oil or obviously defensive monopoly stocks like the growth stocks in the US. And I think that is the trade that is the positioning that investors are thinking about or are worried about. It's not so much about recession, but it's the idea that central banks might accept a higher inflation target de facto, that might accept an inflation target above 2% for a prolonged period of time. I think that is the real risk for capital preservation, in our view, and that's how we're positioning. We want good yields. We want good yields in fixed income, at least 10% yields. Obviously, we want alpha, but we also think about real assets, and we don't see value in government debt here as governments continue to spend across the board, both in the US and Europe.
Okay, you don't like duration. You've made that pretty clear. What are you adding, Alberto? What would you like? What is looking opportunistic and attractive at this point, Alberto?
So right now, there's still value and there's still very short positioning, very crowded short positioning in European credit, particularly across banks, not just in France, but also other countries in the periphery. So that's something that investors will have to cover. European banks are still giving you a yield spread over government bonds that is roughly twice the spread of the equivalent US banks. So credit is attractive in Europe. Europe is not. France is on a higher deficit trajectory. It might get downgraded in the future, but it's not going to exit the euro on Monday. So the fears of tail events in Europe are overdone. We also like upside in equities, both in Europe and in the US. And there are some sectors where it is very inexpensive right now, especially cyclical sectors that might benefit from Trump administration spending, onshoring, and sectors that can pass on inflation to customers.
Okay, Alberto Gabel of Andromeda Capital. Thank you very much indeed for the views there on the politics and the market implications for France, Europe, and of course the US. An almost 0% chance expected in terms of majority for the national rally of Marine Le Pen, but the inflation risks as well, maybe being underestimated in terms of a potential Trump presidency in the States. Alberto, thank you.